So, what is the RSI indicator? RSI stands for Relative Strength Index, and it's an indicator that you apply to your charts that is often used for identifying overbought or oversold markets. So let's apply the RSI to our charts. At the top here, click Indicators. Type in R, and it'll show up right here. Click Relative Strength Index, and then it will be applied to your charts along the bottom. Now, this line here is 70 on the RSI, and this line here is 30 on the RSI. Everything at or above the 70 line is what we call the overbought region. Everything at or below the 30 line is what we call the oversold region. So in relative terms, when the RSI line touches the 30, just like it is right here, it indicates that the price of the asset you are looking at is cheap. When the RSI line touches the 70, just like it is right here, it indicates that the price of the asset you are looking at is expensive. Again, this is in relative terms. So how is the RSI indicator traditionally used? Now, this is what most traders do. When the RSI enters oversold, they'll start buying and entering long positions, expecting price to go up. When the RSI enters overbought, they'll start selling and entering short positions, expecting price to go down. Now, here's the problem with using the RSI indicator like this. Notice how at this level here on price, the RSI has already entered oversold. So if you started to buy and enter long positions, price would have continued to go against you for quite some time before it finally reversed. What this means is, in heavily trending markets, the RSI indicator can stay inside of the overbought or oversold region for a long time. And if you keep taking trades solely based on the RSI indicator, expecting price to reverse, you will most likely rack up a significant amount of losses. So this then leads us to a question we often get asked, which is, how do we use the RSI indicator where it actually helps our overall analysis? Now, we use the RSI indicator in one way and one way only, which is combining RSI with divergences, or RSI divergence. So, what is divergence? Divergence occurs when price is moving in the opposite direction of the RSI indicator, which can then be used as an early indication of a possible, keyword possible, trend change. So in this uptrend here, price made a higher high, but on the RSI, it made a lower high, which created a divergence and resulted in a reversal of price. Again to the left, price made a higher high, whereas the RSI made a lower high, which created a divergence and resulted in a reversal of price. So going in the opposite direction. In this downtrend, price made a lower low, whereas the RSI made a higher low, which created a divergence and resulted in a reversal of price. So let's cover the types of divergences we look for. Now, there are many kinds of divergences people use, but here are the main two types that we look for as part of our RSI strategy. First is wide divergence, and second is tight divergence. And under each type, there are two subtypes. Subtype 1 is when the divergence occurs at or inside of the overbought or oversold region. And subtype 2 is when the divergence occurs close to the overbought or oversold region, but does not touch. So let's go through the first type, which is wide divergence. Wide divergence is exactly what the name states it is. It is divergence where its swings are very wide and very obvious to spot on the charts. Here is an uptrend. We had our divergence, which then triggered a reversal. Notice how wide these swings are, hence the name wide divergence. Same thing in a downtrend. We had our divergence, which then triggered a reversal. And again, notice the clear, wide swings and wide divergence. So how do wide swings relate to price action? Wide divergence is also what we call high quality divergence, because we like to see wide swings and price moving sideways before looking for any kind of reversal trade, because it tells us that the side in control of the dominant trend before the reversal is no longer in complete control, hence causing the wide swings in both directions. Now again, there are the two subtypes of wide divergence, which is 1. When the divergence occurs at or inside of the overbought or oversold region. Notice how it's clearly occurring in the oversold region. Or 2. When the divergence occurs close to the overbought or oversold region. Notice how it's close but not touching. So, moving on to the second type of divergence, which is tight divergence. Which is exactly that. It's divergence where the swings are tight or very close together. Here's your downtrend. We had our divergence before the reversal occurred. But notice how the swings are very tight, hence the name tight divergence. Now, in this example of tight divergence, you can still see the swings of price, but sometimes with tight divergence, it isn't as easy to see, especially to the untrained eye. So here's an example. This here is tight divergence. At first glance, it might not look like it, but this is what price is doing. Run, small pullback, run. Meaning this here is your lower low, while the RSI indicator made a higher low, which is clear tight divergence. Again, this might have been harder to spot for some traders. So here's an easy trick. At the top of your charts, if you click this button right here, it will turn your chart into a line chart. So let's do exactly that. Let's turn this exact chart into a line chart. Now, notice how you can clearly see price making the lower low and the RSI making a higher low, showing a clear tight divergence. And then once you identify this on the line chart, jump back to candlesticks. So here's another example. This here is where your divergence occurred. And here is the movement that price made. Run, pull back, run. Price made a higher high, while the RSI made a lower high, hence your divergence. Again, let's switch to the line chart to show this more clear. Here you can now clearly see the swings of price. Higher high, lower high, clear divergence. And again, when you're done, just switch back to your candlesticks. So when we get to the strategies section, you'll understand why tight divergence is just as important as wide divergence. So again, we have the two subtypes of tight divergence, which is 1. When the divergence occurs at or inside of the overbought or oversold region. This is clearly occurring in the region. Or 2. When the divergence occurs close to the overbought or oversold region. Notice how it's close but not touching. So let's put both wide divergence and tight divergence on one chart as a quick recap. Wide divergence, reversal. Wide divergence, reversal. Wide divergence, reversal. And then tight divergence here, reversal. So as a quick recap, here is our divergence hierarchy. Now all divergence is good, but just use this hierarchy to rank the quality of the divergence and the trade you are looking at. So let's keep building on this and move on to the next section, which is combining divergence with confirmation. So, divergence combined with confirmation means you look for price action after the divergence occurs to confirm that the reversal is real and not a fake out. So let's break this down. This is a clear moving uptrend as price is making higher highs and higher lows. Run, pull back, run, pull back, run. You then spot this clear, wide divergence formation. Now, this is what we call divergence unconfirmed, because it can start as a divergence, pull back slightly, and then still continue on. And then you would have been faked out and took a loss. Don't forget that you are trading counter trend. So just an RSI divergence alone isn't enough, because that would be guessing based off an indicator. So what you need to do is combine RSI divergence with price action after it occurs in order to confirm that the reversal is real. Now, there are many price action strategies we use in combination with divergence, but to keep things simple for this video, one great way to do this is to apply a dynamic trend line onto the immediate trend. Then, you wait for the break through the trend line to occur, which then confirms the divergence and confirms the reversal. As a bonus, this breakdown also made a lower low. And at this point is when you go to the lower time frames and start looking for short entries. So let's show this again. This is a clear moving downtrend, as price is making lower highs and lower lows. You then spotted your clear wide divergence. This again is your divergence unconfirmed. So what you do is you put a trend line onto the immediate trend and wait for a break to occur. As price came up, there would still be no trade for us, as price failed to break the trend line. It's not until you finally had your break here that we would consider long trade entries. So you are probably thinking, why not just jump right into a trade at the second head of divergence here? Well, you don't know this move would occur, meaning price could have pulled back slightly and then continued down. Again, you are going counter trend, and counter trend trades need extra confirmation as they hold more risk. So this works the same with stocks. Here's the Disney stock. You again had your moving uptrend as price was making higher highs and higher lows. You had your clear wide divergence. You then had your trend line applied. And once you had price break through the trend line, the divergence is confirmed, which presented a possible short trade opportunity. So let's go through the same concept, but with tight divergence. Here's your clear moving downtrend. You then spotted your tight divergence. So let's switch this chart to a line chart to show this more clearly. Again, as you can clearly see, higher low on the RSI, lower low on price, which is divergence. So jumping back to candlesticks. After this divergence was identified, we put a trend line over the immediate trend, and once price broke through is when the divergence is confirmed, which presented possible long trade opportunities. So this works the same with stocks. Here's the Pinterest stock, clear moving downtrend. You then spotted your tight divergence. Let's again switch to the line chart to show this more clearly. Again, as you can clearly see, higher low on the RSI and lower low on price, which is divergence. So back to candlesticks. So again, we put a trend line over the immediate trend, and once price broke through is when the divergence is confirmed, which presented possible long trade opportunities. Now, here's a great example as to why you need confirmation and why to not enter trades solely based off of divergences. Here's the Walmart stock. Price was clearly in an uptrend as you had your run, pullback, run, pullback. Now, you would have then spotted this great wide divergence here, and you thought to yourself, this is a great short opportunity. What you are forgetting is that this is a very strong uptrend. As you should already know by now, you would only start considering short entries after the divergence if you had the trendline break, a break through the key support, and price making a lower low. Without that, the divergence was unconfirmed and there was no trade. To make matters worse, a lot of traders went long at this access point here, where the trend line and key support level both lined up perfectly.